Good morning. Welcome to the Retirement Report. I'm Hank Parrott, your host. With me, my good friend and special guest, Dr. Friday with Dr. Friday's tax and financial firm over in Brentwood, Tennessee. And she is a tax expert for individuals and small business owners. We were talking a little bit about provisional income formula and how that works. But before we get into that, I'm going to offer out again for the first 10 callers to my office this morning, 615-376-5325. If you would like to get a personal view, your personalized plan, if you will, which includes a lot of things we're going to be talking about today, would be, of course, applied to your personal situation and in more depth. And if you want to meet with Dr. Friday, she'll come to that meeting as well, or we can arrange a meeting with her. Special offer, first 10 callers, free retirement income analysis. We're talking about a comprehensive financial plan. So it's talking about tax planning, an investment analysis, and investment planning, financial planning, which means taking a look at your financial future. I can show you what your financial future is going to be 10, 15, 20, 30 years down the road based on things you're doing, and then share strategies with you on how to improve upon that plan. So again, first 10 callers to my office, 615-376-5325. We'll get your information, send you out a checklist of things to bring to your appointment with me. So again, 615-376-5325. Tess is standing by. She'll get your information. She'll send you a checklist of things to bring to your appointment with me. And when you come in to see me, I will give you a free copy of my book, 7 Steps to Financial Freedom in Retirement. All right, one of the things when I do these consultations, by the way, that's not just, I know I see all the time free consultation, and I've had people come in to see me. It's just
a generic run through. People are like, well, here's what you could do. They don't really answer your one-on-one questions, which is one of the reasons probably Hank and I have always worked so well together, is we kind of have the same core. And I send clients his way all the time, even just for the free consultation, because of the fact that it's more than that. I mean, that's what I love, is that he basically answers their questions. When should I do this? When should I do that? Will I have enough money to retire when I want to? These are important questions that people have, and they need an answer, not just, well, statistically.
And we're going to give you an actual plan. I mean, this is going to be a written plan. So what I do on these plans is we actually go through everything. So we're going to look at what you have for income, all right, what your expenses are, what your assets are, what if any liabilities you might have, debt, for instance. And we put all that together. We apply inflation to the inflation rate to your expenses, how much they're going to go up. This is going to be a real world some tool that you can use. We're going to look at your income and cost of living adjustments. We're going to add in Social Security with same thing. If you have a pension, does it have cost of living or doesn't it? We're going to have all that factored in. Rate of return on your investments. We're going to not only look at what your rate of return is, but we're also going to be very practical and looking forward. And one of the things, as an example, when it comes to investment income, investment rates of return, we coming out of the longest bull market in history, up through until 2018 when we had our first negative year. And in that period, though, in that bull market period, we've had like 12% a year average return from the market. Think of that, 12% a year. It's crazy. Now it hasn't been like 12, 12, 12. No. It's like 22 and 0. And then you get 12. But it's these averaged out 12% a year for 10 years. But if you look at the 10 years prior to that, from 2000 to 2009, we actually had a negative return in the market. So you got less than 0. Okay, now think about that. So you blend the two together over the last 20 years, that's an average return of between 5 and 6%. And most projections are that's what we're going to see from the market over the next 20 years. Is about that. They're actually saying about 4.5 to 5 has been the projections for rates. And by they, I mean people like Jack Bogle, who just recently passed, in Vanguard. He was the founder of Vanguard, talking about that kind of rate of return. McKinsey, which is an international research firm, same thing. BlackRock, largest money manager in the world, same thing. So there's a consensus there, and we want to pay attention to that when we're looking at our projections going forward. The portfolios that I use also we look at their 20-year history relative to the market, and we can see an improvement on that return by doing that. So these are some of the things we talk about when we get into your planning, is we want to look at what you're currently doing, but we also want to be practical looking forward of what our expectations might be for the future. All of that is part of this, and we can then show you what your, and the taxes on everything. This is another big. We're going to reduce for taxes both on the income seat and also require minimum distributions. When you're taking that money out, guess what? You got to pay tax on it now. And it's ordinary income tax rates. These are the highest income tax rates. You're not getting any special tax treatment as you might with long-term capital gains as an example. We'll get into that more. So all of that's part of the planning. So when you go out, you're going to have a report that's going to show you all those things I was just saying, so you'll be able to see each year whether your accounts are growing or shrinking over time. And then we look at that and say, okay, here's some things we can improve. We look at the risks that you currently have and say, how can we minimize those risks? Are there ways that we can, for instance, save you on taxes? Or there's some tax planning here that you could benefit from? Roth conversions, is there a strategy, is that a strategy that you would benefit from? All of this is part of that planning. So it's not just a 1-hour consultation. It basically sometimes, most times takes 2 to 3 visits to get that report, that plan in your hand, that you have something to use going forward, okay? All right, so again, first 10 callers, that's what that was for. All right, now we're going to try to help you today with some stuff. So provisional income.
I'm like, get back to the subject, provisional, which is 50% of your Social Security plus what other your other income. And it's important to understand that's that 50% of Social Security, because a lot of people will look at their income tax return and they'll say, well, I made $40,000, so I'm not going to have to pay tax, or $20,000, so now my Social Security is not taxable. That's not always the case. If you're single, you have to take half the Social Security, which will probably kick you over the $25,000. Therefore, part of your Social Security could become taxable. Had 3 cases, I was telling you, Hank, during the break, where people had taken Social Security thinking it was tax-free money. And then the IRS sent them a sweet little love letter saying, whoops, you forgot something and here's your tax bill. And so, you know, knowing when to take your Social Security, maybe if you're still working and you decide it is a good thing to take, you know, Social Security can take out federal withholdings. It's a good thing to make adjustments so that you're paying the taxes as you go instead of waiting for the love letter at the end.
And this is it, understanding how that provisional income formula works, as Dr. Friday was saying. Most people today, because these tax code, this hasn't changed. When this was first implemented back in the early 80s, okay? That's, you know, as far as the taxation of these benefits is actually in, let me think, 89, or for early 90s rather. So anyway, taxation of the benefits of first implemented on Social Security was back then. It's actually coming out of Reagan's term into Bush Sr. So then the next time implemented was during Clinton's years. Now up to 85% of Social Security benefits became taxable. And the formulas they use, the income formula that qualifies this, haven't changed in all those years. All right, so in other words, inflation, everybody, hasn't it? Right? We're seeing that the amount of money that's being made is greater. All right, based on inflation alone, more and more people are having to pay tax on their Social Security benefits. So when you do the formula that shows you that it's going to be taxable, then there's a worksheet that the IRS provides where you can calculate out more specifically. Or, of course, what do you want to do? You want to go see an expert like Dr. Friday and have her do your taxes for you. Then you know, if you have someone that does your taxes, they're going to understand this, or they plug it into the software and you know, to help you with that. But when it comes to tax planning, all right, so what do we talk about? Tax preparers, they're the ones to make sure that they put the right numbers in the right boxes to keep you out of the big box with the bars on the window. This is the good thing. However, wouldn't we like also to do some tax planning, and not just this one time of the year, but throughout the year, to be able to meet with your tax person and do tax planning? Friday and I work together quite a bit with clients, because what are we doing? We're doing tax planning throughout the year. Right. So she's checking with me about certain investment rules. I'm checking with her about, you know, hey, can we run this to see that, you know, on this Roth conversion, that this is going to not create additional taxes or problems for us that we, you know, didn't otherwise see. All of these, you know, because some of that you just got to run it through to make sure. All right. There's hidden. We still have that hidden tax called alternative minimum tax for one thing.
Yes, we do.
So understanding how these things work. So when we're doing tax planning throughout the year, when I'm doing reviews with my clients, we're always looking, you know, is there anything different that we want to do here? Do we want to tweak it any way to minimize taxes? Has anything changed that they're going to receive monies, you know, or sell something in a, you know, say real estate that's going to generate a capital gains tax, and what impact is that going to have?
Because that can have a big impact on Medicare.
Yeah, there you go.
I've got 3 cases in my office where they just didn't realize by selling either stock to pay off some debt, or one case case, they sold a rental property, and now their Medicare has jumped up quite a bit because they've made some decent capital gains, and Medicare doesn't really account for that. So
yeah, basically Medicare says if you make the more money you make, the higher the premium you're going to pay, and this has to do with both Part B premiums, your outpatient premiums, as well as Part D, your prescription premiums. So again, this is why it's so important to do the planning before you pull the trigger on something you're thinking. If you're thinking of, I'm going to sell this, so I'm going to use this money for, I don't know, I want to pay down the mortgage, you know, if that's the case, or I want to take a special trip, you know, I've got this big vacation, you know, I had a client recently, I think it was last year, maybe it was wanted to pull $50,000 out, was going to take the family and just do this huge blowout world type of, you know, travel trip, and I was excited. I was like, wow, that's excellent. Exactly. But what we wanted, where do we take that 50 from of her different accounts? And that was where we get into the planning piece. Well, we want to, you know, let's take a look at this and see what the impact is going to have tax-wise. Exactly. And then we know which accounts we're going to pull from to minimize the taxes and, of course, still accomplish the goal of taking this family trip.
And I like the idea of the planning really quick, only because sometimes I've seen where Hank has done something like late in the year and then early in the year to give them in a 2-year spread what they were wanting to accomplish, but keeping the taxes almost minimal just by planning it in advance instead of coming in and say, next month I want to go do this, and boom, you don't have the maneuvering room you need.
Again, that's why I like meeting and doing reviews with clients about twice a year, at least. And I have some clients that come in 4 or 5 times a year because of the types of things going on in their lives and the things that we need to address. But this is the importance of comprehensive planning. It's keeping you on track. It's a great way to minimize risk in your planning, minimize risk in your investments, and again, minimize taxes, which is a big one. All right, we're gonna have to take a break, and then when we come back, I want to jump into more. We tapped on Social Security a little bit, what the effect is. I'm going to talk a little bit about Ross and some of the other things that, you know, ways that you can both minimize taxes now going into this year. We got tax planning. I mean, this one you're going to be, you know, filing. It's a great time to look at the taxes, plan ahead for the year, and then think in terms of another meeting before the end of the year, and we'll talk about that as well and why that's important. But first, we'll take a break. Join us here. We'll be right back on the Retirement Report.